Silver and gold had strong showings this holiday week. Silver appears to be closing up some 70 cents an ounce, closing near $15.40 a troy ounce. Gold is closing the week likely above the $1,280 US dollar per troy ounce threshold, about $20 above last week's close. This past Sunday night, on December 23, 2018, U.S. Treasury Secretary Steve Mnuchin tweeted to the financial world an unsettling message to many, one which will likely go down as a bigger public relations mess than he and his wife's 2017 solar eclipse visit to Fort Knox. Stay tuned as I discuss this tweet and other financial market volatility matters with a new guest to the show, Christopher Irons of Quoth the Raven podcast. Before we begin, a quick message from our show's sponsor. SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. Having now served over 100,000 customers around the world with over 10,000 positive online reviews, SD Bullion continues to gain industry market share by being one of the premier low-cost options for physical precious metal bullion buyers and sellers. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online, 24 hours a day, 7 days a week. Discreet, low-cost delivery is both fast and always fully insured. You can also choose to purchase various qualifying gold and silver IRA products, which can be held in your individual retirement account for long-term wealth preservation. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information. Before this week's interview starts, a quick warning to our listeners. If you've never heard Chris Irons or his Quoth the Raven podcast, you may not know that he often uses colorful rated R language when he speaks about the financial markets. Rather than fill this audio with a bunch of bleeps and language censorship, I've decided to simply let the audio play as was recorded. Do not listen to this podcast if you are offended by language you might hear in a rated R film. Do not listen to this podcast around children. Do listen to this podcast if adult language does not offend you, and you are interested in hearing someone explicitly speak about how they view financial markets currently. Welcome to this week's Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us this week is a new guest to our show. He is Christopher Irons of the Quoth the Raven podcast. Chris, thanks for taking time for us today, and welcome to the show.
Yeah, it's my pleasure. Thank you very much.
Hey, Chris, I ran into your show last few months. Various people have referred me to it. Jason Burrock of Wall Street for Main Street was one of them. And as
good guy.
Matter of fact, another guy that works in the SD Bullion shipping fulfillment department, he's a big fan of yours, and so much so that I asked him, I said, you know what, why don't you give me some questions to ask Chris when I speak to him today? And so we're gonna have a couple of those questions hopefully toward the end of the interview to kind of cover, but. Just a general introduction to the audience out there. I mean, just who are you, and kind of start from there, I suppose.
Sure. Yeah. Well, I'm pretty much just a regular schmuck from Philadelphia. My name is Chris Irons. I've been working in the financial world for probably 7 or 8 years now, kind of formally, and maybe a couple of years before that informally. I have my own little research name that I publish under called Quoth the Raven Research. I also work for a company called Geo Investing, helping them do research. They focus mainly on microcap stocks and helping expose. We were kind of instrumental years ago in helping expose a lot of U.S. listed China-based frauds. They actually made a movie about what we did called The China Hustle, which was produced by Mark Cuban, the billionaire. So you can check that out. It's on Amazon, I think, if you're interested in that. And prior to starting work at Geo, I had started publishing under my own name, Quoth the Raven Research, which I've been doing, since 2012 now. And I'm coming up, I guess, on 6 or 7 years doing that, which is kind of wild now that I think about it. And just in February this year, launched my own podcast. My views on many things differ from my employer, and they were kind enough when I signed on to allow me to just continue with my own personal views on things as long as I made that clear. So I've been doing that for 4 or 5 years that I've been here, and we focus kind of on two completely separate things. I talk a lot of macro stuff. I'm not a huge fan of the Federal Reserve, as I'm sure you might know already. I'm kind of a conspiracy theorist, gold hugger, tinfoil hat wearer, and none of that really carries over into what I do at Geo. We work on separate kind of stuff there. So on my own, I went and started the Quoth the Raven podcast, which is basically just to talk about nonsense and bullshit that I would normally want to talk about with anybody that was sitting next to me having a beer at a bar. It wasn't supposed to be some super formal, financial discussion. It was supposed to be something you could listen to while you were having a whiskey. And the guests that I bring on are just people that normally I would want to talk to. They're not, I don't have some crazy, list of guests. I'm not reaching to try and get Warren Buffett on or, any type of names like that. I'm just basically having conversations like I'm having with you right now, just shooting the shit with like-minded people who have a little bit of common sense and aren't, Steve Leisman getting a, 3-foot boner talking about the Federal Reserve and what a great job they do.
Right. And I've been listening to your podcast now for, I don't know, maybe 2 or 3 months. I always enjoy it. It is exactly as you describe it. It's basically an explicit, no holds barred conversation that you might have with one of your best friends who has an interest in finance. I have been very impressed. You've had on some pretty big names in the financial industry. I think you just had on Peter Schiff for a second or third time. I think you had Bill Fleckenstein on just for a second or third time recently too. So it's definitely been really fun listening to you speak with these guys, because these are some pretty big.
Well, you can give the credit to them, because guys like Peter Schiff have a lot more to lose by coming on my podcast than I have by having them on my podcast. I mean, these are guys that have kind of made their name as mainstays in the financial industry. I mean, Peter Schiff's a guy he's on television once a week. He's a very well-known asset manager across the globe. So he's bearing a lot of risk by coming on the podcast of some jerk off from South Philadelphia. So the credit goes to him as opposed to me. But I think in the case of Peter Schiff, he told me his son follows me on Twitter. And I think that's kind of how I got my in there. His son probably, I think he's 16, he said, probably likes to dick and fart jokes, and probably told his dad, all right, go on the podcast.
Oh, that's cool. And the Bill Fleckenstein interview, I mean, he's a pretty big name in the industry. How did you end up getting to speak with him?
Well, Fleckenstein was the first person that came on the first podcast that I did. And it was as simple as I sent him an email and he said yes. I mean, that was it. I didn't send him a resume. I didn't send him anything. I was like, look, because this was probably just about 6 months or a year after he went on CNBC. He was on their Fast Money program and basically came on, was talking to Tim Seymour, who had asked him about, his outlook on equities, which was decidedly bearish, I'm sure. And Tim Seymour started giving him a lot of shit and saying to him, oh, yeah, I bet you bought gold at the bottom too, and making all these little petulant remarks to him. And Fleckenstein came back to him on the air and said, don't be such a jerk. And I was like, you know what? He is being a jerk. It's totally uncalled for. And I was like, this is a guy that I'd love to have on my podcast. I'd watched Fleckenstein's interviews in the past. I know that we're like-minded when it comes to, monetary policy and economic theory. We don't agree on everything, but I was like, yeah, fuck CNBC. Let's have this guy on my podcast. And he agreed to do it without any question. So I give him also an immense amount of credit. And then we later found out that we had some mutual friends. And so I think he became a little bit more comfortable, but not sure that either one of us knew what to expect that first time.
Nice. Yeah. And just to add insult to injury in those CNBC interviews, I mean, we're talking short form, right? He has 4 minutes to talk and someone is making jokes with him. And so half the time he has to sit there and defend himself. It's pretty ridiculous, the entire format.
Well, and it's just, first off, it's extremely disrespectful. And it's a terrible way to do business. I mean, I understand that to some degree that's how the mainstream media works, but like, what the hell do you expect? First off, 4 minutes is not enough time for anybody to go on CNBC and make their case about anything, whether it's buying an equity, buying a bond, buying precious metals, buying a currency. It's just not enough time, but then to take some of that time and spend it insulting him after you're the ones that have invited him on the air is an insanely disrespectful thing to do. If you don't agree with him and you don't want him, and he's not joining the party that you want him to join, as he said, say you don't agree with him and wish him well, and that's it. But you don't take shots at the guy like it's like we're watching the fucking Kardashians or something. Like, we're trying to have a discussion here, some civilized discourse. So that was one of the things that made me say we need something different. And I listen to a lot of podcasts myself. My favorite ones are long form podcasts that are several hours at length. I'll listen to some one day and then I'll continue to listen to it for a week or a month, but I like the information without the interruption. I like people being able to develop and make their points. And that's the opposite of the mainstream media. And that's what I'm trying to do on my podcast.
Well, I want to swing this back toward this past week because, this past week I was, a little bit bearish, thinking, what, precious metals might not do too well going into the first quarter of this year. But given what Steve Mnuchin did on Sunday evening, just a couple days ago, this tweet that he sent out where he started talking about, having to call various banks and, even the discourse became Plunge protection team, et cetera. I mean,
right.
I'll obviously in this interview, I'll make sure that this tweet gets put up in the video so people can see it. But what did you think when you saw this? I mean, this had to have been pretty shocking to you too.
Well, it's a fucking clown show. That's what I thought. It's the gang who can't shoot straight. It's like watching a vaudeville act. It's just it's a total. I mean, look, we have an equities market that has tripled over the last 10 years. Okay, and now we get a 20% little pullback correction when you look at a 10-year chart of the S&P or the Dow barely even registers. It looks like a blip on the radar. And this moron is now out calling the heads of the banks to make sure there's ample liquidity and then publicizing that. Like, what is that? There's no real need for checking in on whether or not these banks have ample liquidity. Like, it was never a problem to begin with. So the only thing that happens when he does that is, he's putting into the minds of investors that maybe there is a problem about liquidity. So, I mean, it's a ridiculous thing to do. It's a completely stupid and asinine thing to do. It was probably the worst possible thing he could have done. The market would have probably recovered on its own if he had just let it be and had just, allowed the waters to calm a little bit. But, it's just stupidity. And the idea that something needed to be done just because the market was down 20% is a ridiculous idea. Because the market is allowed to go down 20%. It's allowed to go down 50% if it wants. At some point, buyers will step in. At some point, sellers will step in. And that's what a market is. That's how the market works.
I mean, you had Donald Trump as well this week. I think he came out talking about the Fed again, smashing it. He said the only problem our economy has is the Fed. They don't have a feel for the market. They don't understand necessary trade wars or strong dollars or even democratic shutdowns over borders. The Fed's like a powerful golfer who can't score because he has no touch. He can't putt.
Right.
Right. I mean, it's like insult to injury. This came on maybe the next day in the morning, right after Mnuchin's tweet about calling all the banks. And anyone that was watching the market, it was a half day traded on Monday, Christmas Eve, and it just shot down straight down. I mean, neither of these tweets were helpful, I would imagine, in investor sentiment.
Well, it is a wholly ridiculous endeavor to embark on. It just doesn't make sense. Okay, you have to think about what the psychology is of the Treasury Secretary being so rattled, or maybe it was the president who put pressure on him. What is the psychology of the Treasury Secretary or the president being so rattled by just a 20% move lower in equities, which have been making all-time highs for 10 straight years? What's the psychology that is making them freak out? It is insane. It's as if these people have no idea how markets are supposed to function. And the idea that we need to micromanage the markets and micromanage every part of, the economy is an absurd idea. And we'll find out the hard way if we don't decide to back off the gas a little bit, which is, we'll wind up like Japan, or we'll wind up like China. We'll have a completely state-run economy and a completely state-run market. And, it'll be a total disaster.
Yeah, I mean, it looks like even the plunge protection team, that was trending on my Twitter feed the other day.
Yeah, mine too.
Just to inject that into the discourse of finance is pretty funny. I mean, for anyone who's ever paid attention to it, it is a real thing. It does exist. It's something that came about during Ronald Reagan's era, and it certainly looks like it's in operation as far as, I think, 1,000-point Dow move yesterday. And immediately when that happens, the mainstream financial media is just, loving it and just putting it out there like, oh, all's well, the stock market rebounded. And when you go back and look at it, well, yeah, it might have rebounded, but today it's down, I think, pretty strongly. The whole thing, like you said, it seems pretty micromanaged and pretty crazy to be overreacting like so.
Well, and when you look at the fact that, back when Asher Edelman was on CNBC in 2017, he was making comments about the plunge protection team, and half the panel was acting as though the whole thing was made up, which of course it isn't. It's that President's Group on Working Markets, or whatever the hell it's called, is a real thing that came into existence, I think, during the Nixon administration. So the people that are denying its existence to begin with are not only dead wrong, but they need a harsh reality check. And when CNBC pitched that interview on Twitter, they referred to it as a conspiracy. Okay. And it's not a conspiracy. And this is proof, because we have Mnuchin who, look, in an ideal world, if this thing existed and you bought into this Keynesian bullshit, maybe you would tap these guys on a 50% pullback. You would start to, things got really out of hand and there was extreme austerity. You say, oh, okay, well, we're going to check in with these guys. But this boner, Mnuchin, starts throwing the term around now with the markets down, just 20%, which is it's an absurd thing to do. And it not only confirms that they're real and that they exist, which of course everybody with half a brain already knew, but there's no conspiracy. I mean, people call me a conspiracy theorist for suggesting that the Fed buys S&P futures, okay? And what I always say is, now I don't know if they do or if they don't, but I think it's likely. I think that they probably can if they want to through various avenues. And all you have to do is look at the bond market. I mean, how much has the Federal Reserve manipulated the bond market by just taking trillions and trillions of dollars of shit and putting it on their balance sheet? And people think it's impossible that they do the same thing with equities or the same thing with index futures. I mean, if we learned one thing from yesterday's 1,000-point gain in the Dow, it's that the individual components of these indices are not leading the indices higher. The indices are moving higher, and the individual components are following them. And I know that because I put out a tweet yesterday that said, hey, I have 32 charts on my screen right now, aside from gold and the VIX and maybe one or two other ones. 28 of them all moved in the same direction when the market went up yesterday. They all paraboled upwards, and they all closed near highs of the day. So the tail is wagging the dog, and it's been like that for a while. The idea that it's a conspiratorial or completely absurd that maybe the Fed may be in the S&P futures market or maybe in one of the futures markets relating to equities is not this insane idea like the media makes it out to be. And, like the government makes it, well, it's against the law. They could never do that. It's bullshit. You think the government gives a shit about what the law is? You think they wouldn't trounce over a little law here or there if the populace was going absolutely insane and everybody thought that they were going to lose all their money? Give me a break.
Right. I think for me, one of the most eye-opening things, at least in the commodity space, is and Chris Powell over at GATA points this out all the time. I mean, the CME group in 2017 was giving high volume trading discounts to central banks and other proxies that work with central banks. So essentially, right, the central banks can now trade for futures contracts, COMEX, NYMEX, and get trading discounts. I think that discount it ends January 31st, 2019. So, I mean, I don't know what that date means, but maybe it'll be in line with a melt up in commodities to come. But the bottom line that, it's never reported in the mainstream media that central banks are indeed trading the very contracts that describe the price or prescribe the price for real things in the real world, like crude oil, like gold, like silver.
And we know that the central banks of other countries, are actively involved in the U.S. equities markets or actively involved in their own equities markets. So the idea that it could be happening in the U.S. it's not conspiratorial. I mean, to me, it seems more likely than not, right?
Yeah. I mean, we're sitting at the Federal Reserve, their balance sheet has about $4 trillion right now at the moment that they're, slowly getting some of it off. But obviously with this market downturn, we've backed ourselves into a corner here, it seems like, with the baby boomers, the unfunded liabilities, the pensions not being fully funded, et cetera, where,
the pension obligations across the country are ridiculous.
Right. I mean, you're talking about hundreds of trillions of dollars in net present value that have not been fully funded. Someone described in an interview I was watching yesterday, I think it was Rick Rule, he said, the net worth of U.S. citizenry is like 100 trillion, and you have unfunded liabilities and pensions of 200 trillion. So that where does that go?
What are you going to do? You're going to raise taxes to 100%?
Right. I mean, essentially everything goes to devaluing the currency or defaulting, one of the two, and probably a mix of both, right?
Of course. Number one, I think, is likely.
Yeah. So, I guess we're moving toward. I want to move over, if I could, to some of my colleagues' questions. He just shot them over to me. It looks like if you don't mind, if we go down that rabbit hole, because I think Nick has been listening to your podcast for a while here, and he's got some pretty detailed questions.
Cool. Awesome. I hope they're not too detailed.
All right, so he says currently it can be art.
I like being able to bullshit my way around things.
All right, we got a few here, and so currently he says it can be argued financial media is completely dishonest, and their bias of pushing good news has tainted their objectivity and their comprehension of reality. There are a couple of news sources that don't give you an aneurysm when you consume them.
That's a great question. I mean, I guess a better way to answer it would be there's individual personalities that I can tolerate. Like I'm not anti everybody that's on CNBC. I just think as a whole, the inherent long bias that they carry over and give to people that watch them, that, there's a lot of institutional people, whatever, people in the know, but there's also a lot of retail investors that watch that like they're watching a football game. They're looking to see what the score is of the stock market, right? And like whether or not their team's going to cover for the day. But there's people on, I'll say some nice things. Like, you know what? I like Carl Quintanilla. I mean, he's a guy that when he's on, I can tolerate him. I can listen to him. I think he does a relatively good and objective job. I don't mind Becky Quick in the morning. I think she does a relatively good job. And this is all things considered and given the circumstances. I met Tyler Madison this past year in Las Vegas. So I thought he was a very sweet guy. I thought he was very nice, very humble, very honest, very funny, good guy to hang out with. I've met the Nigerians. They're actually pretty nice guys. I talk once in a while to Josh Brown, who I think, despite having some fundamental differences with me and probably how we view the markets and view the economy, I think is a sharp guy and is, for the most part, on point. But I just think as a whole, CNBC's content is carries with an inherent long bias. And like I can watch Bloomberg. There's never been a time where I've turned on Bloomberg and I've said, oh, this woman's an idiot or this guy's an idiot. There was maybe one or two. I forget the guy that used to be on with Steph Rule.
Yeah.
Back when she was there. But there were one or two times when he was talking about the Herbalife fiasco and I was involved in that. I was like, this guy's an idiot. But other than that, I've pretty much been able to tolerate Bloomberg for the most part.
Yeah, just to maybe on Bloomberg, I have them on my Apple TV, and that's a pretty good app on Apple TV if anyone's out there looking for mainstream financial media news. Although it's mostly like the short form stuff, so you're clicking on an interview. At the most, they'll be like 8 minutes long. And
yeah, but they seem to spend more time, like a lot of times when like Carson Block will go on and talk about like a new short report he's published or something, they'll give him the time to unpack it and explain it. They won't be accusatory. They won't praise him. They'll just poke around and ask questions. And I feel like CNBC, there's got to be, it's either full on, we've got a boner for the stock market, or they're pressing at, trying to be sensationalist at some points. And I think there's a lot of morons and a lot of nonsense that come on there as guests. There's some people I like watching, but I think there's a bunch of people that go on there that if you or I or your listeners or my listeners put on a fucking bow tie and a pair of fancy glasses, we couldn't go on and say things that are twice as relevant and probably, twice as more prescient than a lot of the people that go on there. So a lot of people are just talking shit. Macro analysis, for the most part, is just making a lot of shit up. I was reading a headline right before I got on the phone with you. It was like, top strategist sees 20% move in so-and-so next year. And it's just like, those headlines are so ubiquitous, right? Like the term like top strategist gets tossed around so much. Like nobody's a top strategist. The guy's not Jeff Gundlach managing $150 billion. He's not a top strategist, okay? I never fucking heard the guy's name before. You never have. Your listeners never have. My listeners never have. So he's not the top strategist in our household.
Right. As if the top strategist in the world would be giving out his views on
yeah, right?
That's great.
It's just insane. So there's so much of that, just mindless drivel and nonsense. And, like I said, what do you expect from a network that's got Kramer on there giving one stock pick every 15 seconds? I mean, how prescient do you expect the analysis to be in a situation like that?
Have you had the chance to subscribe to Real Vision? Do you like their shows?
No, I saw one interview that they did, and I thought it was very well done. There's been a couple little independent interviews. Like I like Jim Grant's podcast, so I'll listen to that once in a while. I think Jim Grant is a fucking genius. I think his son, Charlie Grant, is also a fucking genius. I think it's his son. I think Charlie Grant's his son. But regardless, I'm pretty sure they're related. If they're not related, it doesn't matter. I think they're both geniuses, but I'm pretty sure they're related. I don't know much about them, but I read Charlie Grant, everything he writes in the Wall Street Journal, and I love Jim Grant's podcast. I think he's got a sharp wit. I think he should be on television every other day, not the people that we're rolling out to tell us that they have a $4,000 price target on Tesla. Give me a fucking break.
Yeah, and obviously you've done a lot of speaking with Mark Spiegel, one of the notorious shorts in Tesla, in the Tesla camp.
Yep.
I've kind of beat on Tesla yesterday or last week with one of our guests, and I'm sure you have Tesla takes, probably ongoing. I mean, that has been a really, really wild thing to watch this past year or two.
Yeah, I think it's only going to get wilder.
Yeah, I would expect the same, right? I mean,
I think if the price continues to fall, it's going to turn into somewhat of a self-fulfilling prophecy. And I'm not just talking about bondholders not being able to convert to equity. I'm talking about confidence. I'm talking about the sanity of the CEO. I mean, they have the perfect prescription for, they have like every red flag that I've seen in a company that I've looked at separately, one of which would make them suspect. To me, they set off a lot of red flags. They have a complacent board of directors that's apparently full of idiots. They have a CEO who's, in my opinion, a total narcissist and just a complete liar. I mean, I just don't believe anything the guy says. Mm-hmm. They're making what now is kind of a commodity product in electric vehicles, that Audi and Jaguar are now competing with them, that they're not really ripping huge margins on. They're consistently burning cash. They made this heinous acquisition of Solar City that I think is still under investigation, or is the subject of a lawsuit, of which it should be, in my opinion. They've made an insane amount of promises that I don't think that they're going to be able to keep. They still haven't delivered a $35,000 Model 3, which is how they drummed up 420,000 deposits for this thing in the first place. And now the chickens are coming home to roost with this guy, and he's shuffling assets between, there was just an article the other day on Zero Hedge about him shuffling assets between SpaceX to pay for, the Boring Company, where he did this ridiculous tunnel unveiling the other day, which I don't know if you saw it, but
I did.
Oh my God! I mean, once the general public starts to understand that this guy is not the second coming of Christ that they think he is,
Right.
once that boils down and trickles down to the people that are, in my neighborhood in South Philly, the plumbers and the welders and the everyday person, once they start to understand that this guy doesn't possess any type of supernatural powers that everybody thinks he does, then the shit's really going to hit the fan.
Right.
And Mark Spiegel gets that, and he's got it for a long time.
Yeah, for sure. I mean, that guy, he's out there every day, just, battle wounds and scars to show for it. But Mark makes a very, very good case on your podcast in case anyone out there wants to hear it. Mark Spiegel is the guy's name. So Nick has another question, if you don't mind me throwing it in there. He says, if there's a paradigm shift and the U.S. dollar was no longer the dominant reserve currency, what do you think would happen to the price of equities in the United States, and what types of items would you like to own to protect your net worth?
Well, obviously, I want to own things that have a relatively finite, supply, right? So I want to own commodities. You would want to ostensibly, in that situation, get out of the dollar, right? So you would either want to move into some foreign currencies and some emerging markets. I think if we start to have a currency crisis, I think somebody wrote to me the other day, he's like, "Oh, it'd be good. We could export more, if the dollar was weaker." So I don't think that's how it's going to happen. I think, we have a currency crisis. You have to think about the inflationary side for the consumer and how much of a slowdown there would be in terms of spending, especially with wage inflation obviously lagging behind, inflation in general. So the consumer would basically just see prices going up, and would be less able and less inclined, I think, to spend, which I think in turn would negatively affect and far offset, this, maybe we can export more items. You know what I mean? Like,
Yeah, no, I get it.
Procter and Gamble is not exporting toothpaste and deodorant. That's not,
right.
not what we're doing, right?
Right.
So I think consumer spending would grind further to a halt than it already is. I think it would put the screws to anybody that has, look, in that type of situation, I want to be in gold. I want to be in silver. I want to be in any type of dollar denominated commodity that is going to rise in price as the dollar loses purchasing power. It's a really simple equation, right?
Yeah. He asks one more final question, then we'll jump off this interview if you don't mind.
Sure.
He asks, he says you've talked about the need for like a 200-year plan for a country in your podcast and how the U.S. fails to seem to have that. Do you think there's any countries currently that have faith in their 200-year plan, or is there a window everyone has to depend upon themselves and just hope their country maintains?
I don't know.
Go ahead.
The most confidence-inspiring thing I've seen of late, believe it or not, has been from Venezuela, who, after they scrapped the entire bolivar, just said, all right, well, we're going to have to come up with a currency now that's backed by the oil and mineral deposits of the company. I was like, okay, well, that actually makes sense because they're trying to create a currency that's backed by something. I don't know if it's going to work or if it's not going to work. I think Venezuela is probably fucked beyond repair right now, unfortunately. But that said to me that if other nations have similar issues with the currency, that they might start to embrace the idea that we need to have something backing our currency other than just, whatever's in the dumpster behind the White House. I mean, we have nothing backing the currency.
Right. Right.
So that I think was semi-confidence inspiring. I think it was the right move for them. Other than that, look, I don't feel like anybody really has a 200-year plan. I don't feel like anybody's really looking that far out. And I think that is going to be, by the time we realize we're fucked, we're going to be so far past the point of no return that it's going to be too late. And I don't know if it happens in my lifetime. I might go through the rest of my entire adult life being the guy that was wrong. But I do think it happens at some point. I don't know if it's 50 years or 100 years, but this outlook that we have now, which is make everything better with Band-Aids from the Federal Reserve at any cost possible to the middle class, is ridiculous, and it's unsustainable, and it won't continue.
Yeah, I mean, historically, I've done a little bit of research on this, writing for SD Bullion, and whenever you have a huge gap between the wealthy, the very, very wealthy, versus the poor and the middle class shrinking, if that goes on for too long, bad things happen. The reversion for that is typically either war, a plague or some type of revolution, right? I mean, it's really
plague.
Yeah, exactly. Social, like think French Revolution type stuff. I mean, that is the type of reversion that typically happens historically. So, my hope is that would never happen. None of those three would ever happen. But you are playing with fire if you allow that to continue.
Agree, and my mindset is always, in terms of how I'm positioned, just better safe than sorry. I mean, what's the difference between having, 50% of your portfolio in equities or 80%, you get a little bit more exposure to other things that would, theoretically appreciate in value in a situation like that. I don't think it's a bad trade-off. And I don't know, for me, at least helps me sleep a little bit better at night, but that's just me.
Yeah. Well, peace of mind is important, and, worst case scenario, kind of planning for that kind of stuff. I think, especially nowadays, given all the things that we've discussed and all the other things we may discuss in the future, I mean, it probably is prudent and wise to have a certain portion of your wealth in things that are outside the system.
Exactly. And I did a presentation on that in May of this year on YouTube, and it's just called "Short the Whole Fucking Thing." You can look it up. It's just about thinking about diversification as a way to get some of your exposure, as you just said, outside the system. People don't realize that owning stocks and owning bonds that are both U.S. dollar denominated is not being diversified.
No, not at all. But that's been the trend for 40 years, so maybe that's all some people even know or can even recognize.
Oh, I think undoubtedly, you're right.
Yeah.
Yep, I think that's the case.
Yeah. Well, Chris, I really do appreciate you coming on the show. I want to give you the chance to tell listeners how to find you so they can hear your work and see your show.
Oh, you can just put it in the in the description, right? It's in there.
Mm-hmm,
yeah, so there you go. I don't want to be too promotional.
What about your Twitter handle? What's your Twitter handle? Give it to us, Chris.
It's at QTR Research.
All right, cool. Well, Chris, on behalf of all the listeners out here, we really do appreciate you coming on, and have a happy new year, and we'll talk to you again soon, hopefully.
Yep, same to you so much. Thanks for the call.